Good morning, everybody. This is Chris Robinson, Rob's Ag Marketing, coming to you from Nashville this morning. Be here for a couple days, then head back to the Great White North, Chicago. It's nice to be somewhere where there's no snow for 48 hours. Well, we're digesting what was a nothing burger in the USDA. Um, the CFTC did publish uh, commitment to traders, but it's from a month ago, so it's to me it's meaningless. I hate even quoting it. I mean, we knew part of the reason we rallied $1.50 is because someone got long beans. So yeah, thanks for telling us now a month later. And however many they were long, they are in trouble now because again, if you follow me, if you follow my letter, I keep track of this stuff. I know it's hard to keep track of it. Um, that's why you have a service like mine where you listen to somebody like mine. But bottom line, kids, spot beans rallied $1.57 from 10.12 to 11.69. Right, that all happened after October 1st. Okay, October, November. We peaked out in November 11th. Excuse me, November 18th, 11/18, 2025. We hit 11.69 and a half. Well, this low, um, you know, if the bull doesn't get fed every day, the bull gets angry, and the bull's angry now, and that might be the topic for the day, right? We went from 10.12 to 11.69. We've now given back over half. When we hit 10.90, that was over half of that rally. So we're sub 11, we're sub 10.90. The next downside risk is 10.72, and then I hate to tell you this, but there's a gap down there at 10.62. 1063, which is October 24th. So it's just a shame if you did not reward the rally. But I look at it this way: half of something's better than 100% of nothing. So 1090, the last time I checked, 1090, 1085, it's still a hell of a lot better than 1012. So you may kick and scream and be mad at the world, but if you need to move beans or hedge beans, don't let the last half of it get away. There's arguments out there now, which there always are now. You know, looks like China's taken about 4 million metric tons of the 12 they promised us in South Korea. Now there are other arguments. So it's like, when is the crop year? Is it Scott Bessent's crop year? Is it China's crop year? Is it the U.S. crop year? We're getting into this type of argument now, which just makes me want to hold my nose. Um, the bottom line is, kids, for 15 years, 20 years, China took 25% of our soybeans. But they've been working the whole time on figuring out how to not have to do that. They've been playing chess while we've been playing checkers. So what did they do? They went down and they built roads and bridges and all kind of infrastructure, billions of dollars worth of stuff down in South America. Why? Because they wanted to get those beans out of Brazil. Go back and look at pictures of the Brazilian harvest, 20 years ago, 15 years ago, 10 years ago. They'd line up hundreds and hundreds of trucks. Then the truckers would go on strike. It was just a mess. China saw that and they're like, right, let's build them some infrastructure. So they're making sure those beans that are getting grown in Brazil get out. And they did a lot of that. They got long a lot of beans before the election. I think they were anticipating if Trump won, they'd have another trade war, and they were right. So they've got so many beans that they're actually having to sell beans out of their stockpile at home to bring in the new beans. So that should tell you something right there. In other news, the Argentinians, they lowered their tax exports, so it makes it easier for their farmers to export stuff. What's that done? Well, that's going to bring more wheat on. Argentina had a great wheat harvest, and that's going to bring more wheat on the worldwide market. And our wheat market is reflecting that, sadly. May wheat, Chicago wheat, KC wheat's all down 3, 4, 5 cents. I'm concerned about March spot wheat challenging the contract lows. Again, if you want all this information, I do a pretty extensive breakdown every morning and then every weekend of key levels, both for bulls and bears. I don't beat the bushes too much about telling you how to make turn $1,000 into $1,000,000. There's 1,000 brokers out there that'll do that, 1,000 advisors that'll do that. What I'm trying to do is help you defend your business risk, whatever that is. If you're a producer, your business risk is the price drops before you sell it, period. If you're an end user, you're always worried about a drought or a embargo or something where you can't get your hands on your inputs, and then you're paying through the nose there. So Take a look, Robinson Ag Marketing. I'll be sending a letter out this morning shortly. Looking ahead to what's going on. Again, you got to watch new crop soybeans. They're at 10.91 and 3/4. I was worried about $11 not holding. The high of the move was 11.30, but that was a 17-month high. That was an 83-cent rally off the October low. So there was an opportunity there. Now we're going to see if this congestion level at 10.85, 10.75 holds. We are going to be kicking the can until January, the January USDA report. No two ways about it. So we'll see what happens till then. Generally, the last 2 weeks of trade are very, very choppy in the grains. Doesn't mean there won't be some opportunities, but I think that the USDA kicked the can. There's a nothing burger there, and the market reflected it. Moving on to the cattle, it just comes down to this: how much more of the $85 collapse and $45 collapse? It was 88 in the it was 85 in the feeder cattle and 45 in the fats. How much more of that can we recover? Right, we've recovered. We're trying to recover half in the March. March feeders have got to get back up into that gap, that 340 area, where it's been sitting here kind of spinning at 330. Here's the news, though. I mean, we bottomed out at 293. The last time I checked, 330 was a lot higher than 293, about 40 bucks worth. So hedge what you can, defend what you can, capture that revenue. You kind of got a bit of a mulligan. You got almost half of what we gave up back, and it came in 8 days. It took 5 weeks to lose 85 cents, and in 8 days we recovered half of it. That is why we hedge, because you never know when these markets are going to turn. April fat cattle sitting there at 226. Same idea applies there. Can we get above 230? There's a gap up there everybody's looking at, which comes into play at around 231. So 231, and then it gets filled at 232.70. That's what I'm looking at in April. Again, can we get there? I hope we do. But if we don't, I want to make sure you capture as much of this revenue as you can. And April lean hogs finished lower yesterday. Again, we had a pretty severe sell-off there as well, from 95 cents to we bottomed out at 81.10. We've clawed back 38%. For some reason, we can't seem to get above 87.20, 87.5. There's a lot of congestion there between 88 and 90. So does this sound like I focus on technicals? Yeah, I do, because barring a fundamental story, we are slaves to the technicals right now. And so you don't have to embrace them 100%. You should be aware of them. They can help you make better decisions when you're marketing your animals or your livestock. One bit of good news on inputs: you got crude oil under 60 bucks, trading at 58.08. That's also given us a little bit of a breather in heating oil. I was looking to see if we could get below 220. This 226 area, it's about a 6-week low in diesel. It's the lowest price we had since October 22nd. So here we are, almost nearly a 2-month low. But call it a 6-week low. We'll see if we can get diesel fuel futures back sub 220. Why am I telling you that? Because a large part of your operation for some of you is input costs. If we get a little dip down here to 220 or 215, that might be something you want to take a look at. All right, this is Chris Robinson, 312-638-8868. I'm in Nashville today. I'll be back home tomorrow. Have a great rest of the day. Give me a call.